On October 27, 2025, the United States unleashed a new wave of sanctions targeting Russia's state-owned oil giants, Rosneft and Lukoil. This was a dramatic escalation, no longer just targeted restrictions, but a full-scale economic blockade of Russia's most vital industry. The goal, to cripple the financial engine fueling Moscow's military ambitions. Unlike previous sanctions, which allowed Russian oil to flow at a discount, these new rules impose a total ban on all U.S. transactions with Rosneft and Lukoil. Even more consequential, secondary sanctions threaten to cut off any foreign bank, trader, or shipping company dealing with these firms from the U.S. financial system. The Treasury Department's message was blunt. We are taking decisive action to deny the Kremlin the resources it needs to fund its illegal war. This transforms the global oil market into a new geopolitical battlefield. Every nation and company must now choose a side. Doing business with Russia's energy sector is no longer a neutral act. Dr. Angela Stent of the Brookings Institution called it the most significant escalation in economic pressure on Russia since the Cold War. She described the previous price cap as a clever but leaky mechanism. This, she said, is a sledgehammer. The sanctions are designed to create maximum pain and force a change in President Putin's calculus. The world is left to wonder, will this high-stakes gamble succeed, or will it fracture the global economy and push us into a new era of bloc-based trade? The stakes have never been higher. The next moves will shape the future of global power. Oil and gas are the lifeblood of Russia's economy, funding everything from social spending to the military machine. By targeting Rosneft and Lukoil, the U.S. is striking at Russia's most critical vulnerability. Every barrel of oil sold funds the war effort in Ukraine. The new sanctions are not just punitive, they're a tool of attrition, aiming to starve Russia's war machine. Previous sanctions had loopholes. Russia built a shadow fleet and used non-Western insurance to keep exports flowing, mainly to India and China. The new secondary sanctions aim to close those loopholes, threatening any international entity that helps Russia sell oil with exclusion from the dollar-based global financial system. Now, a bank in Dubai or a refinery in India must choose, do business with Russia, and risk losing access to the U.S. market, or comply with sanctions. This marks a shift in Washington's approach, acknowledging that earlier measures weren't enough. The decision to directly target the oil sector is a high-risk, high-reward strategy. If it works, it could shorten the conflict. If it fails, it could trigger a global energy crisis and accelerate moves away from the US dollar. The world is watching to see if this gamble pays off. The outcome will reshape the global economic order. The stakes could not be higher. Moscow's response was swift and defiant. President Putin condemned the sanctions as economic aggression and vowed to find new markets for Russian energy. Behind the rhetoric, Russia moved quickly, offering steep discounts to China and India, hoping cheap oil would outweigh the risk of U.S. secondary sanctions. The Kremlin accelerated efforts to trade in yuan and rupees, expand its own financial messaging system, and invest in a shadow fleet of tankers. For Moscow, building an alternative economic ecosystem is now an existential necessity. Russia also hinted at retaliating by cutting off other critical exports, like enriched uranium or titanium. Its leverage over Europe is diminished, but the threat remains. The Kremlin's strategy is a mix of defiance and desperation, willing to disrupt global markets to survive. The world is watching. Can Putin's pivot to the east weather this economic storm? The stakes are nothing less than Russia's economic survival. The next chapter will be written in Beijing and New Delhi. The market's reaction was immediate. Brent crude prices surged over 10%, topping $110 a barrel. The threat of millions of barrels of Russian oil disappearing from the market sent shockwaves through trading floors worldwide. In Russia, Rosneft and Lukoil stocks plummeted, and the ruble weakened sharply. Oil tankers carrying Russian crude were left idling at sea as buyers, shippers, and insurers feared U.S. secondary sanctions. The global oil trade's logistics were thrown into chaos. This turmoil highlights the immense power the U.S. wields through control of the dollar and global finance. By threatening to cut off access, Washington compels compliance, even from those with no direct U.S. ties. But this power comes with risks. Volatility in oil prices creates winners and losers. Oil producers like Saudi Arabia benefit, but importers face inflation and economic pain. The immediate mood is fear and uncertainty. The long-term question, will this shock lead to stability or a new era of volatility and risk? The world holds its breath. For Europe, the timing couldn't be worse. As winter approaches, soaring oil prices threaten a new energy crisis. Despite efforts to diversify, Europe remains vulnerable to global price swings. The main fear: inflation. Higher energy costs ripple through the economy, raising prices for everyone. Central banks may be forced to keep interest rates high, risking recession. European governments are preparing emergency measures, subsidies, tax cuts, and pleas to Middle Eastern producers to boost output. But oil exporters may prefer higher prices, leaving Europe in a bind. The unity of the West is under strain, as leaders balance solidarity with the US against domestic economic pain. Rising energy costs could fuel public discontent and empower populist movements. The coming months will test Europe's resolve like never before. China and India now face a stark choice. Both have benefited from discounted Russian oil, fueling their economies and keeping inflation in check. But the threat of US secondary sanctions puts this trade at risk. China's official response was sharp criticism, but its state-owned energy giants and banks are risk-averse and deeply tied to the global financial system. Major players are likely to proceed with caution, fearing exclusion from the dollar system. India too is under pressure. Cheap Russian oil is vital for its economy, but its growing partnership with the US makes open defiance risky. Both countries are watching how strictly the US enforces sanctions, testing boundaries with smaller banks and traders. This is a high-stakes game of cat and mouse. If China and India comply, Russia's isolation will be nearly complete. If they find ways to defy the sanctions, it could mark the rise of a non-Western economic bloc. Their decisions will shape the future of global trade. The world is watching Beijing and New Delhi. The outcome could redefine the global balance of power. These sanctions are more than a tool for Ukraine. They're a pivotal moment in the global power struggle. Washington is flexing its dominance over the world's financial system, showing allies and adversaries alike the reach of the dollar. But every use of secondary sanctions pushes other nations to build alternatives, trading in their own currencies, creating new payment systems. The current crisis will accelerate these efforts, potentially leading to a fragmented global economy with rival blocs. Even US allies and developing nations worry about the precedent, fearing instability and the erosion of multilateral institutions. The US must balance punishing Russia with maintaining a broad coalition. This is a test of two visions: American-led order versus a multipolar world. The outcome of the oil sanctions will have profound implications for global leadership. The world is watching to see which vision prevails. The stakes are nothing less than the future of the international system. As the dust settles, the future is uncertain. Will Russian oil be shut out, and can other producers fill the gap? The answers will shape the global economy. The world is now more vulnerable. One geopolitical move can trigger cascading consequences. If China and India find ways to keep trading with Russia, it could accelerate de-dollarization and fracture the global order. If they comply, US dominance is reinforced, but at the risk of alienating rising powers. The sanctions force a reckoning with globalization itself. Are we entering an era of friendshoring and strategic competition? The US has made a bold bet: short-term pain for long-term strategic gain. Whether it pays off remains to be seen. The consequences for Ukraine, for global power, for the world economy will unfold for years. October 27, 2025 may be remembered as the day the era of globalization ended.